everybody. Welcome back to my channel Rapid Revision. This is question number 2 of February March 2024. The question here says Samir buys and sells on credit. He has provided the following information. They've given you total trade receivables at the start of 2023, and then they have given you certain totals for this year of 2023, and at 31st December they've given you some totals here, and then they're saying here, in addition, one of Samir's trade receivables, Ria, has become bankrupt, and Samir will not receive the $178 which she owes to him. Samir thinks he will receive most of the other amounts uh, due to him from his trade receivables. So Samir thinks that Ria will not be able to pay Samir because Ria has become bankrupt. So in the first part, they are saying prepare the journal entry to write off the amount owed by Ria. A narrative is required. So when you basically record irrecoverable debt, in this case, this is going to be an irrecoverable debt. So I'll write here 31st December 2023. I will write here irrecoverable debts account debit, because obviously you were basically the amount that Ria owed us, we are going to write it off, and we are going to write it off as a business expense, and this is going to reduce the business profit. So we'll write here the irrecoverable debt debit. So irrecoverable debt is an expense account. Expenses are debited. So you record here $178, and you will write Ria credit. So Ria is the person who owes us $178, and basically when she owes us, that means she has a debit balance. We have a debit balance in Ria's account, that is balance brought down $178. But since she cannot pay us, so when you will write this off, you have to credit Ria's account, and I'll write here irrecoverable debt in Ria's account, because it's an irrecoverable debt of $178. And in the irrecoverable debts account on the debit side, I will write Ria, and I will write $178. Since Ria cannot pay me, I have to transfer the amount that is there in Ria's account into the irrecoverable debt account, because irrecoverable debt is an expense. In the narrative that I need to write, they have written here a narrative is required. I'll write here amount owed by Ria, amount owed by Ria, written off due to Ria becoming bankrupt. So in this case, basically Ria is becoming bankrupt. That is why she cannot pay us, and therefore we are going to write off this amount. Whenever they ask you for the journal entry to write off irrecoverable debt, you should simply do irrecoverable debts account debit. You need to credit the customer's account. The customer in this case was Ria. She wasn't able to pay us, right? Trade receivable is also our credit customer, and Ria was a credit customer in this case, and she wasn't able to pay us. A credit customer normal balance is a debit balance, but when the credit customer is not able to pay us, you need to credit the credit customer's account. That is in this case, it's Ria. In the next part, they are saying state 2 reasons why Samir should use a provision for doubtful debts. So provision for doubtful debts, there are 2 accounting principles that are applied to provision for doubtful debts. Number 1 is prudence. Prudence principle says that you need to create a provision so that you can account for losses that are going to appear maybe in future. So in future, maybe some of my credit customers might not pay me, so that is why I need to create a provision for that. Also, by creating a provision for doubtful debts, I comply with the prudence principle, which says that which says that the business should not overstate their profits, and the business should not overstate their assets. So here, when Samir basically creates a provision for doubtful debts account, he avoids overstating his assets and profits. Hence, he is complying with the prudence principle. Also, to comply with the matching principle. So the matching principle says that revenues of one period should be matched against the cost of the same period. So if, for instance, if from 2023's sales, I expect certain people that they might not pay me, but I'm not sure about it yet. They haven't become bankrupt, but still I think that there is a certain amount that I will not recover from 2023 sales. So I will basically show the expense in the same year. So the expense is shown in the year when the sale is made. So in the same year, whenever we are expecting, let's say from 2023 sales, we are expecting that certain people will not pay us. So in the same year, we'll show an expense by making a provision for doubtful debts. So that is why provision for doubtful debts is very important. In the next part, they are asking you to make a sales ledger control account. You guys also know that sales ledger control account is a total trade receivables account. So it's a basically credit customers account, total trade receivables account. So we can have a specific trade receivable account, like for example, the account of RIA would be maintained in the sales ledger of the business. But total trade receivables means all my credit customers, whatever their balances are, whatever their opening balances are, when we add them all together, that is my opening balance of my sales ledger control account. Here they have given you an opening balance of for trade receivables. So I'll write here 1st January 2023. I'll write here balance brought down, and I'm going to write here total trade receivables, that is 10,115. So I'll write here 10115, and then I'm going to record everything from these totals that are given. So cash sales is not recorded in the sales ledger control account because the double entry for cash sales is cash debit, sales credit. So there's no trade receivable involved in cash sales. Whenever you're making cash sales, you're just giving the goods to the customers and you're taking the money right away. Trade receivable is created when you are giving the goods to the customers, but your customers don't pay you immediately. They promise to pay you in future. So cash sales is basically not recorded in the sales ledger control account because this is total trade receivables account. However, yes, credit sales will be recorded. So credit sales in this case is 124,670, and the double entry for credit sales is trade receivables account debit, um, sales account credit. So we are going to debit trade receivables with sales, and this is going to come on the debit side of the sales ledger control account. I'm going to write here 31st December 2023. The next thing here, returns from credit customers, is my sales returns, and sales returns does affect the sales ledger control account because credit customers are returning goods to us. Sales returns account will be debited, trade receivables account will be credited. I need to record this on the credit side um, of my sales ledger control account. And notice this, that I'm writing sales returns. I can't write returns from credit customers in the details because there's no such account as returns from credit customers. It's a sales returns account. So basically the account title is what you write in the details. Sales returns is the account title. You can't write returns from credit customers. You need to write sales returns here because sales returns is the account title here. You'll write here 31st December 2023. Sales amount is, sales returns amount is 5234. So I'm going to write here 5234. And then bank transfers received from credit customers, which means my customers are paying me. So I'll do bank debit, trade receivable account credit. Money is coming in the business, so bank will be debited, the cash book will be debited, and this will be recorded on the credit side of the trade receivables account. I'll write here bank in the details, and my amount will be 98,620. So I'm going to write here 98,620. This is going to be 31st December 2023. Then we have something here which is cash received from credit customers. So when we are receiving cash from our credit customers, which means trade receivables are also paying us in cash. So cash account will be debited, trade receivable account will be credited. I'll write here cash in the details, and I will write here 11,470 is my amount here, which I'm receiving in cash from my credit customers. Then interest charged on overdue sales ledger control, sales ledger account. So there are certain customers of mine who haven't paid me for a very long time, so I'm charging them interest. By charging them interest, their amount that they owe me is going to increase because obviously I'm going to say to them that now you need to pay me more. Basically you need to pay the amount that you owed me. Also you need to pay the interest because you haven't paid since a very long time. So I'm going to debit interest charged on overdue accounts in the sales ledger control account. Contra entry is simply going to come on the credit side. So contra entry is when your customer is also your supplier. So when my customer is also my supplier, so it's like this. Let's say Mr. A is also my customer, also my supplier. So let's say if I have bought goods of 500 from Mr. A and I have sold goods of $600 to Mr. A. So rather than so I should be receiving 600 from Mr. A and I should be paying them $500. But since the person is the same, right? So it's Mr. A whom I have sold goods of $600, and I have purchased from Mr. A for $500. So that means now simply 500 will be a set off. So we'll set this off against both the accounts, and also Mr. A can pay me $100. So now I will basically this 1833 is the same as the example that I gave you right now was for $500, right? So set off is always done with the lower amount. So this any person who is also my customer, also my supplier, uh, the same person is the customer, also the supplier. So in that case you need to go for a set off with the lower amount. So in this case that is going to be 1833. And then discount allowed to credit customers. So when we allow discount to our credit customers, discount allowed account is debited and trade receivable account is credited. So I'll write here discount allowed. I will write here 3125. 3125 is the amount. And then there was an irrecoverable debt by RIA. So the amount that RIA owed us, we actually wrote it off as irrecoverable debt. So I'm going to write here irrecoverable debt $178, which we owed. RIA owed us, but she wasn't able to pay because of bankruptcy. So now our balance carried down is going to come out to be balance carried down will be 14,464. So I'll write here balance carried down. I'll write here 14,464. This will be my balance carried down. I'll write here 31st December 2023, and then I'm going to balance this T account. So this will balance on 134,924 on both sides, 134,924, and then the balance carried down will become my balance brought down. So I'll write here 1st January 2024. I will write here balance brought down, and I will write here 14,464, which is going to be my balance brought down. So this is simple 9 marks, honestly, because you guys just need to think in terms of any value of any values they've given you here, right? Is this going to increase my trade receivable balance, or is it going to be going to decrease my trade receivable balance? If it's going to increase my trade receivable balance, you record it on the debit side. If it decreases the trade receivable balance, you record it on the credit side, simply because sales ledger control account is also your total trade receivables account, and trade receivables are your assets increase on the debit side, decrease on the credit side. The next part says here, Samir is concerned about his ability to pay his trade payables. He's considering whether to stop allowing cash discounts to his credit customers so that he will have more cash coming in and can pay his trade receivables more easily. So what he's going to do is, so what Samir is considering here is that he's saying that we will not allow cash discounts to our credit customers. So cash discounts, you guys need to think a bit. Cash discount is always given to customers if they pay within a certain time frame, right? So let's say I'm selling goods to some customers of mine, and then I tell them that if you pay me within 10 days, I will give you a cash discount. So what Samir is saying here, that we will not give cash discounts to our credit customers, so that the amount that they are paying, they'll end up paying more. But the drawback of this particular proposal is that then why would the customers pay on time? Because we are giving them cash discounts so that they give us the amount in the time frame that we are specifying. So we want the customers to pay earlier as well, right? So basically, if Samir goes with this proposal, he's not offering the incentive of cash discounts to his customers. I've written the answer already for you. So what I have written here, advise Samir whether or not not to stop allowing cash discount. Justify your answer by providing advantages and disadvantages of stopping cash discount to his credit customers. So if Samir does not allow his customers cash discount, he will receive the payments in full. So that means he will receive more cash. Also, his profit for the year will increase because discount allowed is an expense, and if he doesn't allow customers cash discount, then that discount allowed will not be will not, basically we will not incur the expense of discount allowed. So that means our profit for the year will increase, our expenses will be reduced. If Samir pays his trade payables on time, this will improve his relationship with his suppliers. Also, this may ensure future supplies, because if he's paying his trade payables on time, that's a good thing. However, the customers may not pay on time, as they have no incentive to pay on time. Therefore, may not they may the therefore the cash may not come in quickly, because obviously the discount that we were giving, the cash discount, is is tied to a time frame. So if the customers pay us, let's say within 10 days, we'll give them a cash discount. So the customers basically hurry up in paying the amount so that they can receive the cash discount. If they are not getting any cash discount, they will not be in the hurry of paying us. So also this action may increase the chances of irrecoverable debts. Yes, because maybe the customers may not pay us, because of which Samir's profit will also reduce, because irrecoverable debts is an expense, and expenses basically reduce your profit for the year. In my opinion, Samir should not stop giving cash discounts, of course, because Samir should continue giving cash discounts, because we want our customers to pay on time, and that cash discount just gives them an incentive to pay on time. Suggest one other action which Samir could take to ensure that he has sufficient cash to pay his trade payables. So what he can do is that he can improve his credit control. So he can send reminders to customers, and so that customers pay on time. So basically, he can, keep calling them, like giving them a reminder through through calling them, or sending a message to them that they need to pay their amounts, whatever the amounts are due. That's one way, one action. One other action, when in which uh, like through which Samir can ensure that he has sufficient cash to to pay his trade payables. There's one more way. He can also introduce more capital in the business. So when he introduces more capital, the double entry will be bank debit, capital credit. This will just improve his cash flow. Also, he can take a long-term loan if he goes for a long-term loan or a short-term loan. So even then, that will also improve his cash flow. He'll have more cash for paying his trade payables. But the best thing is that just get the money from the customers on time, so that you can pay your suppliers on time. So that's it for this question. Thank you so much for watching. Hope this helps you guys.